Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. What I wanted to talk about this week, I thought it would be interesting for me to go over some of the questions that I get as a result of the show and as a part of my practice. So this is really going to be a show on almost what is a week as a financial planner really entail. What's it like for a week as a financial planner, and all the questions that come in from the show. And sometimes I answer the questions and sometimes I just have a regular topic. So today I thought I'd start off with answering everybody's questions. And I will let you know if you email me with any questions you'd like to see discussed on any shows, I'll cover them in shows for you. So if you're getting our videos on email, go ahead and respond with any questions. Hey, can you do a show on this financial topic or that financial topic? Whether it's budget or taxes or anything at all, 529 plans, anything that you have questions with that you think I might be able to answer, shoot me a question. Give me an email and I'll try to cover them or even do a whole show on them for you. Now, what I've run into on some of these questions, let me start right off with, and it's a hodgepodge today of the number of things just last week. These are the questions that came in and the things that came up just in 1 week. So what's it like in the life of a financial planner? Well, here we go. So one question I got asked was, can we as grandparents open a 529 plan to help on college educating our grandchildren? And the answer is yes. Can we add to an existing 529 plan that our children already have on behalf of their children, which are our grandchildren? And the answer is yes. So what we typically recommend is we have the parent of the child who's 4 years old or 1 year old or 10 years old. We have them be the custodian over the plan, one of the two parents, let's say. And we name the child who we want the account to be opened for or on behalf of, which brings up another question. What if that child turns out to not go to college? Well, it's an easy solution there because the way 529 plans work, 529 plans allow you to change who that plan is on the benefit of. So if you name and you have 3 grandchildren, all to the same parent, let's say, you open 3 529 plans, or the parents do, and then 2 out of the 3 children go to college. The first child, let's say the oldest one, did not go to college. They chose a different route. All the money that was built up on their account is not lost. It can be used. Remember, a 529 plan, the benefits are any amount of money that is put into a 529 plan, while it's invested and grows and will be tax-free if it's withdrawn in the years of funding the financial expenses for college or higher education. Then all those contributions and earnings come out tax-free. So that's your real benefit of the 529 plan, leveraging that all of the money that's in the account is yours to keep to pay for the college education or the higher education. And remember, it doesn't only have to be college. So let's say the oldest child does not go to college. We say, now what happens? Do we break the piggy bank of the 529 plan and the assets become taxable? Well, you could, but a better solution is you can redirect that 529 plan to one of the other kids, let's say, or both. You could direct that those funds are now used for the other two, still to be used for any of the ones who do go to college. So you can make other arrangements for the child that did not go to college if you wanted, especially as grandparents, let's say. But keep those 529 plan assets intact and move them for whose benefit they are in trust for. So you have the 529 benefits, tax-free for college for the other ones. Make different arrangements for the older child who now did not go to college, maybe did something else in life. So there's the benefit of the 529 plan that we don't want to get lost. So you open, let's say, as a grandparent or a parent, 3 529 plans. They might be with 3 different companies. They might be all 3 with the same company, which brings up the issue of how do you choose companies. You really see, in my opinion, a financial planner to make those decisions. It is possible to do it yourself. So I'm not saying not to do it yourself, but normally most people, if you're asking this question, then the next question's too hard. Where do I go to get it? If you're asking the question of, can I do it? How does it work? That in itself says you probably could benefit by the advice of a financial planner who's done this every single week. We run into this as financial planners, where you're doing it for the first time, and it would be easy to make mistakes. So anyway, you do these 529 plans, and a grandparent, a relative, a neighbor, anybody at any holiday or birthday can now add funds into this account on behalf of that child. So now everybody gets to participate in helping toward the college and higher education expenses for each child. So that's a really nice benefit. So I wanted to share that with you because that was one of the questions I got asked this week. How does it work if you're a grandparent? Can we open a plan? Yes, but we still usually ask to have the parent as the custodian. And we usually use the parent's address as the address on the account, and they still get all the statements, even though the grandparent is the one that was opening the account and contributing to the account on behalf of the parent's children. You know, that's kind of how it works. So that's the norm. Now, another question that came up was, this comes up with 401k plans. If you're married, you get divorced or separated, and even remarried, there can be a complication when you change beneficiaries if, while you're changing beneficiaries, you still were married to the first spouse. So let's say you get separated before you get divorced, and you take your spouse that you're separated off as a beneficiary, and you name your children. And then when you get remarried, you name your new spouse, and then your children as contingent beneficiaries, let's say, for example. If you pass away under that scenario that I just explained, 20 years later, the assets go to the first spouse in some cases. You say, what? The assets go to the first spouse. I'm no longer even married to the first spouse. We've been divorced for a long time, you'd say. Well, the rules were when you took the first spouse off as beneficiary, the spouse has to sign a consent form. And if you did not have that separated spouse sign a consent form, then all future beneficiary designations, including the first beneficiary change, removing the spouse, is many times invalid. They're invalidated, and all future and subsequent beneficiary changes. So I thought I'd bring that up on the show because many people are subject to this complicating rule in 401ks requiring spousal consent, and you didn't know to get it. So be very careful if you're in a situation where you have a spouse as a beneficiary, or even if you don't, and you choose to take your funds elsewhere, that also requires a spousal consent in a 401k world. So when you're looking at your 401ks, you can't transfer those assets freely if there's a spouse involved, even if that spouse is not named as a beneficiary currently. There's still laws in place that prevent you from moving assets over to a separate IRA somewhere else without getting spousal consent. So the forms will many times ask, are you married? If you are married, you're required to get spousal consent, even if the spouse is not currently named as a beneficiary. Be careful with this, folks. These are nuances that we financial planners run into that many financial advisors don't. And as I've said on prior shows, there are differences with being financial planners and financial advisors. Now, we get into this next area, and we've sometimes been seeing articles in financial journals and publications that say, if you have an IRA, should you pay the fees, management expenses for managing those accounts? Should you pay the fees, allow them to be deducted or withdrawn from the account balance, automatically debited from the account balance, or are you better off to deduct, or let's say write a check from outside funds and pay the fees directly? There are two sides, probably 5 sides to this discussion. One is, if your fees are being paid and withdrawn directly from the assets, so let's say there's a $150 annual fee, or let's say there's a 1% asset management fee ongoing. If that fee is automatically deducted from the IRA assets, that's fine. But some people will say you could have deducted those expenses from your income tax if you file a Schedule A, if you're eligible, exceed the 2% threshold to itemize deductions and have enough deductions otherwise to itemize deductions, that you might have been benefited by writing the check from your own checkbook, paying it from outside funds, leaving the inside funds unencumbered by those fees. So pay it from an outside source, and now technically you might be able to take a tax deduction for those fees. But there are pros and cons for this. So it's very complicated. It's more complicated than I just got into. I was just giving you one example of why it might be a benefit and why it might be a disadvantage. There are many more. You need to get to a tax professional and ask that question specifically regarding your own pertinent situation. You have a personal situation, and then you have a pertinent situation. Your personal situation, this may not even apply. But in other cases, your personal situation, this is a very pertinent issue too, to your own taxes, and it will make a big difference. If you're subject to the alternative minimum tax, then it doesn't matter either. So here you paid for it outside of the funds, and maybe the alternative minimum tax takes that deduction away. So it can get very complicated. I wanted to share that with you. Now here's another one. We run into these questions, in fact, this week. If you have an automobile accident, if you have a homeowner's claim, what should you do? How do you handle those? What are your first steps? So let's take a car accident first. The biggest mistake I see if someone's involved in a car accident, especially with another party, is they don't stop and get the information from witnesses. So you look and you say, you're flustered anyway when you get hit. You get rear-ended at a stop sign, let's say. You get out of your car, and the first thing you do is make sure that you're okay and everybody in your car is okay, which is obviously correct. But the next thing is, do you have a witness? Do you have an injury? Are you even hurt? Is there a medical issue? And you look at that and you say, if I have a medical issue, which you may or may not know until 4 or 5 days later, the person behind you may not have given accurate information. They may not have given you their right address, or their insurance information they gave you might be expired. You don't know. So the first thing to do when you get into a car accident, if you're okay, is you get the plate number of the car that hit you. You tell them, wait a minute, while traffic's still stopped, and you go to the car behind it or around and you say, did you see this accident? Can you please give me your name and phone number in case I need a witness? Did you see what happened? That's the first biggest mistake that I see. The second is not getting the plate of the person that actually hit you, because that's very important. So now then you discuss information and get the insurance information. Those are the steps to take when you're in a car accident. If you're at fault, then have your car insurance information in your car, have your registration in your car, and stay calm. Many times people are in an accident and they're too flustered and they're not thinking. So try your best if you have a car insurance claim or accident to stay calm. Now here's the next step. If you're involved in an accident and it's the other person that hit you, and you determine, and maybe your company or so determine that they are at fault, and you expect them to pay for the claim, or whether it's even your fault, when it gets to your own car and your own damages, I want you to get to two shops. We used to do this in the old days. The insurance companies have tried to streamline this and change this. What the insurance companies are trying to get you to do is go straight into their office and have their appraisers give you their estimate and even write you a check on the spot. That is the wrong first move to make. The right first move to make is you get to your own body shop in your garage or your dealer, and you have them look at that car, and then you get to a second opinion source from wherever you trust as a second opinion. Whether it's an auto garage, an auto body shop that you know, whether it's the dealership or a second dealership, you need to have two. Then you get the insurance company appraiser and you call them on the phone and you say, listen, I've had a claim, I have two estimates. These are what the two estimates are. This one is the place that I get all my work done. It's the dealer. It's the auto body shop. It's the garage. This is where I get all my work done. This is where I want my car fixed. Remember, the insurance company, their obligation is, if you're in an accident, to put you back in the same condition to the best of their ability, best condition, same condition as you were before the claim occurred. So you have the right to go to where you normally go to get your cars repaired. They can't send you only to their own garage and say you have to get it fixed here. They can send you to their own garage and say, well, we want our garage to look at this. But they can't say that's who has to repair. So I know a lot of you are running into this, and I've never talked about that on the show, but I'm getting hit with questions on that. Do we have to get it repaired at the insurance company's garage? No. Well, then the second question is, well, if we don't get it repaired at the insurance company's garage, do we have to accept their amount, and any difference because we're taking it to our garage is more expensive? Hey, listen, these dealerships, these reputable auto body shops and auto garages that you deal with, they're used to dealing with these companies all the time. They'll compromise, and the insurance company appraisers will compromise. They'll work it out. But sometimes there will be differences of opinion. And the place that you go to get your car fixed, whether it's a dealer or whether it's a auto body shop, they know what they're doing, and that's why you go there. They may have a different opinion on, no, this bumper needs replaced. and the appraisers are saying, oh no, a repair will be fine. For your own safety, you've got to go to the places that you trust, that 5 or 6 years or 2 years later, if something goes wrong, you have someone to fall back on too that you trust. So that's an important bit of advice, and I don't think I've ever talked about that on the show. But I do want you to do that, and sometimes it'll cause a fight with either your own insurance company or the other insurance company that hit you. Well, that's tough because you have rights. And I wanted to share with you on the show that you do have rights. Now let's get to a homeowner's claim. You get to a homeowner's claim, and let's say there's a water pipe break and water comes through that's sealing and damages your floor underneath and the ceiling up above and some of your contents in your kitchen or in your living room. Well, the way most insurance policies work is this. They will normally write you a check if you are covered, if it's a covered claim, for the initial, what they call actual cash value, which means they're taking everything that happened and all the damage, the ceiling, the carpets, things like that, the couch, the TV, and they're depreciating up front and writing you a check in advance for your TV was $600, but after depreciation, it's $350 value. They'll write you a check initially for $350, but know this. They will write the check for the difference once you repair or replace, with no deduction for depreciation, for full replacement value or repurchase value. So you need to know, don't accept or don't think you have to accept the check that they initially write, because you're entitled to full replacement value, just as on the car insurance, same on the home insurance. You are entitled to be put back in the same condition you were in before the claim with new replacement items without your having to pay the difference because yours was a 10-year-old ceiling or a 5-year-old couch or a 5-year-old TV or computer. You're entitled to full replacement value. So, give our office a call. Email me with your questions. These are some questions that came up last week through emails or my own experiences that I wanted to share with you. But keep the questions coming. I will do whole shows on them if you ask me to with, hey, Jack, how about doing a show on this topic or that topic? I will do that for you. And I will also answer questions if you shoot me emails and say, hey, Jack, can you cover this on next week's show or on a future show? I'll be glad to do that. Again, get on our email list. We send out videos of this show. So go ahead and email us or call us and we'll get your email on the list and send you out the videos of the show too to share with friends, family, or anyone else you think might benefit also. Thanks for tuning in. Remember, the show's at 10:30 a.m. now instead of 8:30, so anyone watching, we've changed our time there. Thanks again, and I'll be back again next week with another edition of All Things Financial.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.